what I like the most when I'm looking for, I'm just going to pull up CVX as an example, okay? This is a perfect shakeout right here. Huge selling, bang, 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 down to the 50, holds the 50. But what I'm really looking for, if I decide to put some capital to work, is I'm always looking for the relative strength leaders in a bear market. Relative strength is one of the greatest guides. As its name suggests, the stock's performance relative to the market gives you a guide to where money's flowing. So what we like to say, and this is a William O'Neill strategy, and it really works, particularly in a bear market, a relative strength will lead the price of the stock. So if you get a relative strength that breaks to a new high, there's a high probability that the price will break to a new high. Now, there are very few sectors of the market that are showing relative strength like that, but the number one sector is energy. And so let me be clear here. Relative strength using the O'Neill investing way is totally different than the RSI index. So those of you using technical analysis, I don't know what sources you're using, and you find what you think is relative strength, and you say, oh, it's the relative strength index. Not the case. If you look at the data on relative strength index, that's a calculation of the relative strength of the stock versus itself over X amount of time. Not what I'm talking about. I'm talking about relative price performance, relative strength versus the S&P. This is a key differentiator. Sometimes people confuse it, so please don't get confused. All right? So some of the charts I'm going to look at right now, I'm going to throw 3 charts up here, okay? I don't have the RSI, I don't have the relative strength index on this chart. I use William O'Neill for that. And sometimes it's a little bit glitchy when I try to pull it over here. But I'll do it and see if I can, while it's thinking, we're going to look at this. And eventually the William O'Neill might recalibrate. We'll be able to look at it. Anyway, what I'm going to show you, if that shows up, and you can take my word for it. So here's the price of CVX. So you have this huge base breakout. So that's stage 1 rally. And then this is stage 2 base that's holding the 50-day moving average. The relative strength is already at a new high. And that suggests price on Chevron is going to go to a new high. It's a 3.5% yield. Okay. Exxon, same exact chart pattern. Price is not at a new high yet. Relative strength is already trading at a new high. Let's see if this thing calibrates. It did. Okay. So now you can see this is SHEL Corporation. Now we already own SHEL in our dividend portfolio. Look at the relative strength line here. This is relative strength right here. So while the stock is consolidating and has been since February, so price is equal to where it was at the peak in February, the relative strength has skyrocketed. Generally, that means price will catch up. It's a great lead indicator. If you don't own SHEL, there's an opportunity to own SHEL. It's already in our dividend portfolio. There's an entry point right there in SHEL if it's been missed. Let's look at Chevron. Chevron, see Chevron right here? The relative strength of Chevron made a new high last week versus the high back here. Price has not done that yet. Price probably does it this week. Exxon, same story on Exxon. Exxon trading below the highs of recent vintage, but relative strength already at new highs. Let's look at Devon. Okay, Devon is just a screamer. Relative strength blew out in here, and it's kind of following price. But even relative strength is at a new high, and the price is not above 70 yet. So probably Devon's going above 70. Okay? So these are basic guides. If I add shares of Devon, your head might explode because that's like not a chart pattern I normally add. But I want to share with you this Ares has been, let's just look at Devon real quick. Devon's the only name I might take a shot at in this group. It's just walking up the 50-day with massive relative strength and a huge dividend payout. So I might put on some Devon right in here, see if it makes a new high. Okay. I'm looking to build a portfolio of very liquid energy names and see if I can make some money. So I'm looking at Exxon, Chevron, Devon, because it's our favorite fundamental E&P company from a natural gas play in the U.S. All of these are dividend plays. They could all go in the dividend portfolio. I'm not exactly sure where I'll put them. I don't know if I'll put them in the dividend portfolio or on the growth side. You say, well, what's the difference? I follow different stop loss rules. So I don't know yet what I'm going to do. Probably Devon goes on the growth side. Maybe Chevron and Exxon will go into the dividend portfolio right next to SHEL. And then I'll own the three biggest international energy companies, all with great dividend yields, all with great stock price performance, all with blowing out relative strength. And that'll go right alongside all of the pipelines that are already in the dividend portfolio.